What is going on, everyone, and welcome back to Explain the Charts. Today is October 23rd, 2025, and we are seeing some serious volatility in the Nasdaq, represented by QQQ. The market is flashing some major warning signs, and we're going to dive into both the news and the charts to figure out what's happening. Yesterday, the markets took a tumble, with the Nasdaq slipping nearly a full %. So, what's causing this fear? First, reports surfaced that the US might escalate its trade war with China, which always spooks investors. On top of that, we had some weak earnings reports from key tech players like Texas Instruments and Netflix, which added fuel to the fire. But the biggest red flag might be coming from the International Monetary Fund. The IMF has issued a stark warning, stating that their valuation models show risk asset prices are well above fundamentals. When a major institution like the IMF says the market is overvalued, we have to pay close attention. Broader economic concerns are also looming, with a potential government shutdown reaching a tipping point that some analysts fear could send the economy into a downward spiral. And let's not forget geopolitics, with oil prices jumping today after new sanctions were placed on Russia, adding inflationary pressure. So, we have a cocktail of negative catalysts: trade war fears, weak earnings, overvaluation warnings, and geopolitical tension. Now, let's see how this is all reflected in the charts. Looking at the daily chart for QQQ, we can see the broader context of the market over the past year and a half. The long-term trend has been undeniably bullish, with the market making a series of higher highs and higher lows. We recently pushed up to new all-time highs, just touching the $612 to $613 area earlier this week. This level has now established itself as a very strong psychological and technical resistance point. However, look at yesterday's candle from October 22nd. That is a powerful bearish engulfing candle, opening high and closing near the lows of the day, completely wiping out the prior day's gains. This type of price action at an all-time high is a classic reversal signal. It suggests the bulls ran out of steam and the bears have taken control, at least for now. This move was on significant volume, adding more weight to its validity. Let's zoom in on the last couple of months to get a better look. Here on the daily chart since August, you can see the push to that 612 resistance and the sharp rejection. The immediate support level to watch is the psychological 600 mark. If we break below 600, the next key area is the low from October 10th, down around 589. That day saw a massive 3.5% drop, so we know that's a volatile area. A failure to hold 589 would open the door to a much deeper correction, potentially towards the 570 support zone we saw in late August and early September. Now let's switch to the 1-hour chart to analyze this recent sell-off in more detail. Here we can see the price action over the last few trading sessions. Notice how QQQ was trying to consolidate near the highs around 611 before the news hit. Then, yesterday, we see this waterfall decline, slicing right through the 610 level with almost no hesitation. The selling pressure was relentless for several hours straight. Since that big drop, the price has been attempting to form a base around the 605 level. This is a critical short-term pivot point. A failure to hold 605 on this time frame would signal that the next leg down is likely imminent. Drilling down even further to the 15-minute chart gives us a microscopic view of yesterday's carnage. You can see the exact moment the selling pressure intensified. Look at the surge in volume on these red candles as the price broke down. This isn't quiet profit-taking, this was aggressive selling. The price cascaded from 611 all the way down below 600 in just a few hours. It eventually found some buyers to push it back up to the current 605 area, but the damage was done. This intraday action shows just how fragile the market is at these elevated levels when negative news hits. Okay, let's switch back to the daily chart and put it all together. To recap, we have a confluence of negative fundamental news and a bearish technical reversal at an all-time high. The key price levels are clear. Resistance is firmly at 612 to 613. Any move back up will face a major test there. Immediate support is at 605, followed by the major psychological level of 600. Below that, our key support targets are 589 and then the 570 to 575 zone. So, what are the likely scenarios? In my opinion, the bearish case currently has a higher probability, let's say a 70% chance in the short term. The combination of the IMF warning and the bearish price action is too significant to ignore. A break below 600 would be the confirmation I'd look for to expect a move down to 589. The bullish case, which I'd give a 30% chance, would involve the market shaking off this news and finding strong support above 600. If buyers step in aggressively here and we reclaim 610, the short-term bearish thesis would be invalidated. However, this seems less likely without a positive catalyst. Long-term, the trend is still technically up, but this could be the beginning of a much-needed, and perhaps significant, correction that the IMF has been warning about. Keep a close eye on volume. A high-volume break below 600 is a major sell signal, while a low-volume drift lower might just be a small pullback. Finally, please remember that this is just my analysis and perspective. This is not financial advice, and you should always do your own research and make your own investment decisions. Trading involves risk, and you should never invest more than you are willing to lose. Thanks for watching Explain the Charts, and we'll see you in the next one.